We helped a couple reduce their lifetime tax liability by over $1.7 million. Today we'll walk you through their financial plan so you can see how the tax strategies we use could also help you save millions. Hi, I'm Jared Kinney, Wealth Advisor with the Noble Group. Today I want you to meet John and Susan. John and Susan are both 57 years old and incredibly thoughtful about their finances. When John and Susan came in and sat down with us, they had the clear goals of legacy, continuing to give to the charities that they care about, and making their retirement as efficient as possible. So today we're going to dive in deeper into what we created for them from a financial planning side, and we're going to show you what that looks like. Okay, so John and Susan have amassed an impressive portfolio of just over $5 million. And so as we see here, we can see that they've also done a good job of asset location, being that they've got $3 million in taxable in the joint account. They also have about $1 million in pre-tax IRAs and 401ks, and they also have $1 million in after-tax Roth IRAs and 401ks. So as we jump into this, our focus for John and Susan was to shift most of their tax-deferred assets into after-tax Roth accounts so that they can be both more efficient in retirement with their income, but also more efficient for the legacy. And so let's look at this from a current standpoint and kind of the proposed. We'll look high level, and then we're going to jump into the details of this. So here you can see on the current plan, the probability of success is still extremely high. Tons of assets at the end of the plan of $20 million plus. But as we look at the proposed side, you can see we're jumping up to 100% probability of success of the plan not running out of money, but we can see a much higher ending value of their portfolio or their estate that they want to pass on to both charities and legacy for their children. So now that we're going to jump into the planning, we're going to start with the tax side, because the most important thing is John and Susan have been doing smaller Roth conversions every year. And a Roth conversion is simple as we take money from an IRA or a 401k that's pre-tax, and we move it over into the after-tax, such as a Roth IRA or a Roth 401k. When we do that, we have to pay tax on that money that we moved over. So if we just add that in, we're going to create a higher tax, potentially putting you into a higher tax bracket. So we want to look at ways that we can control that given each year and how everything's going to be different year in and year out. So let's look at this in a couple of different lights. Okay, so we're going to start with the tax side first, and we're going to look at what John and Susan were planning to do this year before they came and sat with us. Okay, so as you can see here, for last year, John and Susan had, between the two of them, about $360,000 of wages or income. And then from their investments, they pulled off some interest and some dividends. Some are taxed at qualified rates, some are taxed at ordinary income, some things that we can clean up in the future for them. They were planning on doing a $150,000 Roth conversion. They didn't have a plan for that. That just was a number that sounded pretty good to them. They've also had some investments that hadn't done so well, so they've got some losses that they're carrying forward, something that we can use in planning in the future to offset some future gains in the portfolio. Okay, so the big thing when we look at this is they're looking at a total income of $550,000 for last year, 2024. Okay, so adjusted gross income of $550,000. Then we start to look at deductions. Okay, again, John and Susan are extremely charitable with their money. They tithe and they give to Goodwill and some other charities. So we get some deductions from state and local taxes, and then they'd also already given about $40,000 to charities throughout the year, including their church and Goodwill and others. So right now, the itemized deduction of $49,752 way outweighs the standard deduction that they were able to take, so they're definitely going to take that. So when we look down here, we're seeing a total tax for them of roughly $112,000, puts them in the 32% marginal tax bracket, and effectively has about a 22% tax. Historically speaking, not too bad. Okay? So when we come in and we start to look at this, the first thing we look at is What happens if we add more to that Roth conversion? What does that look like for them? So we came in and based on certain parameters, we modeled a $255,000 Roth IRA conversion. Okay, all the same things stay as is with their taxes. The loss carry forwards where they can take $3,000 against ordinary income. But you see here, obviously we're adding from that Roth conversion, we're adding an additional $105,000 of taxable income. So their adjusted gross income jumps up to $655,000. Same deductions apply. We're going to take the itemized deduction again. So our taxable income is now $605,000, and we're adding an additional roughly $38,000 in taxes. Okay. What this does is creates a higher effective tax rate overall, but also on the Roth conversion itself. So what we want to look at is how can we offset that? Being that John and Susan are extremely charitable with their money, we brought a strategy in called a donor advised fund. Right? And what a donor advised fund is it's a way that you can give to charity in advance. So basically what we're going to do is we're going to fund this account, and it's again called a donor advised fund, and the account sits there and you can give to charities from it as you want, but we're going to put in more money than they typically do in a single year because we're going to get a bigger deduction for that. It also comes with some benefits, namely we get the bigger deduction. We also don't have to give to charities in that given year. We can spread this out over a number of years. So we get the bigger deduction, and we can use this charitable account to continue to give money over the years. Basically, we're pre-funding our charitable intentions for the future. Okay? But another big benefit that really worked in John and Susan's favor was the fact that they had some very appreciated assets in their investment portfolio, and mainly in their joint taxable account. And so the benefit of putting some appreciated stock into the donor advised fund is essentially that you don't have to pay capital gains tax on that when you move it over or when you liquidate it and reinvest it in that donor advised fund. To recap that, a donor advised fund is essentially an account that we give money to, appreciated stock, cash, assets of some kind, and we get a deduction up front. And there's rules that the IRS has on how much you can take. That's a little bit deeper than this video is going to go. But essentially we take that, and any deduction that we don't get, we carry forward for 5 years. But we want to kind of put that in so that we take the max deduction possible in this given year. So now back to John and Susan's plan. As you can see here, we added $105,000 to their Roth conversion plan. So we're going to look at adding $105,000 to a donor advised fund this year to make up about 2.5 years of their charitable giving. And this is also a strategy we're going to do for probably a few years into the future. Okay. So you can see all the same parameters stay. We have $363,000 of income, the tax exempt interest because we're investing in municipal bonds inside the taxable account to control their tax rate. And then we have the $255,000 Roth conversion, all the same gains and losses here. But one thing that you're going to notice here as we get down to the deductions is we jumped up to $144,000 of extra charitable deductions, which makes our total itemized deductions $154,000. Okay? So when we look at this here, you can see they'd already given $39,752 in cash and goods to other charities. When we look at doing the donor advised fund, we're going to put $105,000 extra in there and continue to get that additional deduction. Okay, so what this does is essentially negates this extra $105,000 of money that we're moving from the tax-infested IRA into the tax-free Roth IRA. So we're able to put that in, and as you can see, their current plan, where they were going to pay about $112,000 in tax, we are able to pay the same amount of tax, but we're able to get that extra $105,000 over into the Roth, and now we're funding their charitable endeavors for the next couple of years. This is a strategy that John and Susan are going to use a couple of different times until they retire in a few years. And so we're going to grow this charitable fund up over those years, continue to invest it, divest from their appreciated stock without having to pay tax on that. So even though they're paying the same amount of tax, if they ever wanted to sell their appreciated stock outside of the charitable fund, they would have to pay tax on that at typically 15 or 20%, depending on where their income is for the year. So as you can see, this is a strategy that we use for them. It works at all different levels. But let's now take a look at how this is affecting the overall financial plan. We're going to look at the tax side of this first. Okay, so as we look at a summary of these tax strategies that we're going to employ for John and Susan, we just look at some of the high-level numbers that are coming out of this. So essentially what we're looking at is by putting this strategy in place for the next few years, we're looking at about $1.3 million in tax-adjusted or more in tax-adjusted ending assets, while also paying about $1.7 million less in taxes over their lifetime. Basically, this is all accountable for moving money into the Roth IRA, pre-funding their charitable intentions, but also we're withdrawing about $1.4 million less over their lifetime from those tax-deferred accounts such as IRAs and 401ks because we're doing the Roth conversions earlier. So they're not going to have a required minimum distribution issue in the future when they turn 75. That's not going to be a problem. They're not going to have these big balloon distributions they have to take and pay a bunch of taxes to the IRS. The big thing that we talked about was they wanted to control their tax bracket in retirement, and this is the strategy that they wanted to be very aggressive in hitting that, so this is what we're doing for them. So when we look at this here, I want to kind of show this over their lifetime in their plan. So again, this is showing that there's going to be about $1.3 million in additional tax-adjusted ending assets upon their death at the end of the plan. So as you can see here, in the early years before they retire, they're going to be paying a lot more in taxes under the proposed plan. The green shaded area is the proposed plan, and you can see here, their income is much higher, so the tax is going to be higher. But by the time they get to retirement, their tax rate is going to be extremely low, and they're not going to have much of a tax other than from other income that they have in the future. So you can see here that as they go up, if they would have stayed in the plan that they were doing, they didn't do these conversions, we can see as they get up here into their 70s, when they're forced to pull money out of these IRAs, their income is just going higher and higher and higher, where when we have to pull that money out of the IRAs, the IRS controls the rate at which we pay that. So, and here you can see that at the end of their plan, their adjusted taxable income is over half less than if they didn't do these conversions. So the other side of this that a lot of people don't talk about is one of their other primary goals was legacy, and it's essentially a very efficient legacy. So at the end of this plan, instead of passing on those tax-infested IRAs to their 4 children, what they're going to be doing is passing very tax-efficient assets to those children. If they were to pass the IRAs to the children, the way that the law states now, they have to pull those out within 10 years. And so this is a lot of money that would be left in these IRAs that they'd have to be pulling out and paying tax on. And a lot of times they might be in their highest earning years when this is happening. So the tax they would pay on this money is quite substantial. So this is really allowing them to shift the money into these tax-free assets and kind of hit all of their goals all at once. Right? So again, as we see, we're paying a lot less in taxes, but let's look and see what this does to their probability of success. So when we come over and look at their probability of success, this is the probability of not running out of money. 96% and 100% are both very high. The chance to run out of money are almost non-existent. But what we really want to focus on is what did we do to affect the tax on the legacy? Because we know their retirement income is going to be efficient based on what we're doing, but what is that legacy going to look like? So where we want to look is, what are these accounts supposed to be at in the future based on, a projected, very conservative growth rate? And the way that we look at this as we go through these chart of accounts is we can see that our taxable assets are rolling down. We're spending some of that money as we get older because our tax rate is much lower, and we're letting the Roth IRA, the Roth 401k, we're letting those grow, where of the 23.8 million that they're projected to leave behind, the majority of that, all of that but about 1 million is left in the very tax efficient Roth IRAs for their heirs to take on. Now, the same inherited rules stick with the Roth, the 10 years, just like the IRA, but there's no income tax on those assets. So another thing that we're talking about that we're not really in on this plan yet, but the estate tax in the future could be a burden for them. So there might be some other things we need to do because Roth IRAs are includable in the estate at that point. But as of today's rules, they're under the estate tax exemption, so they wouldn't have any estate tax on any of this money. John and Susan's plan was already very strong to begin with. You can see adding, additional Roth conversions, taking care of this earlier while they're working, adding in the ongoing charitable flexibility with the donor advised fund, and then also making sure that we take advantage of these lower tax rates. We're going to be able to, lower their overall tax burden over their lifetime by over 1.7 million. I hope you found this video informative and that you can see how the same strategies we use for John and Susan could also be implemented for you. Right now, we're offering complimentary strategy sessions to any of our YouTube viewers who are interested in walking through this process with us. To schedule a meeting with me, all you have to do is scan the QR code on the screen or click the link in the description. Thanks for watching, and I hope to talk to you soon.